Okay, good afternoon, everybody. Today is May 13th, 2022. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at IBD. Take a moment to read the disclaimer. We are not licensed. We don't offer buy, sell, hold advice. What we do is provide research and education, hopefully teach you guys to fish on your own. All right, so we will talk about the markets, then we'll do the industry groups, stocks to watch, a lot of stocks that I was considering this week. And then a couple of quotes. I had a quote, and then I heard another quote today listening to a podcast I thought was really good. So, if we have time, we'll go through a couple of those thought processes, but a lot is going on in the markets. Not always good, but there's a lot to think about as far as where we are, where we're at, where we've been, and where we're headed. So this is a chart of, I'm not going to say initially, but of an ETF that has been in a nasty bear market. You can see it made a really big move and then it topped. And then what I'm trying to highlight is the fact that you can get a lot of counter trend rallies in a really bad bear market. So the first wave down was 59%. And then in 3 weeks, you had a 27% rally. Then you broke 19%. Then you had an 8% rally in 3 weeks. Not much, but you see 3 weeks, kind of the theme there. Then you broke 40%. And obviously, I'm marking these lows after the fact. You could have easily had a low 3 weeks previous to that. But the ultimate low on that move down was 40%. And then you had a 19% rally, and no surprise, 3 weeks. Then you really broke bad, 48%, as it becomes more obvious, right, that it's not really having any chance of rallying. But now you're so stretched to the downside that the snapback is really tremendous, 61% in 4 weeks this time. And then you've rolled over to 28%. And probably at this point, the volatility will compress in this, and it will go sideways for a number of months before maybe ultimately starting a new bull market. So this looks very similar to ARK. Let's go ahead and pull up ARK, ARKK. And you can see, right, you break, you rally, although this one took much longer, but then when you finally break, you rally for 3 weeks, maybe four, then you roll over, you rally for 2 weeks, you roll over, you rally for 3 weeks, you really roll over, right? You see the theme, right? This is why we look at charts, history, because history tends to repeat itself. Somebody said about the stock market, it's a one-act play. The story is always the same. The players just change. The actors and actresses are just different. And it's so true if you've been in the game or watched history. So ARK is probably, I think, in the midst of some kind of maybe really good rally, and then ultimately will probably roll over and then go sideways for a long time and just play possum, just be done. The cycle is over for the types of stocks that they like to buy, unless they somehow pivot, which seems unlikely. Most of the time, studying history, you go back and look at all the gurus who have done really well in cycles. They have a really hard time changing their strategy and going with the market. And the cycle changes and they get left in the dust. Jim Ropel was on a Twitter space today, and what he said resonates with me. Every cycle has someone whose methodology, I hate that word, whose methodology perfectly gels, but when the cycle is over, they're done. And that's what happened here. Cathie Wood, ARK, their methodology perfectly gelled with the type of market we were in. It was a perfect storm to the upside. The cycle changed, and unfortunately, it's a perfect storm to the downside, and they don't recognize that because they start to believe their own press clippings. I don't know, I don't know how exactly what's happening there in, behind closed doors. I know Jim said if they just read the big picture at IBD, they might have protected a lot more capital, which is true. Now the big picture might have some false signals, maybe here, maybe there. They thought that was a false signal, but having some type of risk control is paramount to surviving in this business. And they don't. Every single security they own is down on the year, and down a lot. Some of them are down really, really a lot. But it looked a little tired to the downside. So you got kind of this weekly bar. I noticed on Thursday, ARC was up. Let's go to the daily. So clue, and it's easy in hindsight. And I did do some buying yesterday just because I noticed this little subtle clue, but not nearly what I would normally do because we're in a bear market and I don't want to get too cute. But I did notice yesterday, ARC was up while the market was down, pushing lows. Right, the market was really bad till about the last hour. It had a little rally. Let's go ahead and look at the NASDAQ yesterday on a 60-minute. So here at that point in the day, the market's pushing lows. There, I'm sorry, I did that wrong. 2 o'clock Eastern, 11 o'clock for me. You're pushing lows. You have 2 hours to close. But at that moment, I noticed a lot of the stocks that have just gotten beat up weren't going down. In fact, a lot of them were up. So ARC, of course, I noticed it was up. C Limited, I noticed that was up with the market pushing lows and looking really bad. So C Limited was up at that point. GitLab, another stock that I noticed was up at that point. DLO, and these are all stocks that I watched that I've traded before that I thought would be new leaders that somehow along the way, I'm in DLO there, and it just, I don't remember how I got out. I know I got out, of course, but it's just kind of, I have a screen of all these former leaders, and DLO was up. And how about Stone? I mean, it's just incredible. Some of these stocks, how far down they'd gone, but I did notice a lot of them were up yesterday, and it just gave me a clue. I felt like maybe the market's long in the tooth. Now, today, they all had fantastic days. Like GitLab was up 17% today. C Limited was up 22%. Wow. DLO was up 20%. And ARC was up 11%, which is why everyone wants to buy lows, right? Because every once in a while you catch these bear market rallies. Maybe it's a bear market rally, time will tell, but the moves are really tremendous. Like if you study previous history, they can really go a lot. So it just seems like the market's a little long in the tooth to the downside. I had other friends that I follow using exhaustion signals to the downside. David Ryan came out on Twitter and or IBD Live and talked about some of the things he was seeing, felt like the market was long in the tooth to the downside, that it could rally. So that doesn't mean you go long, but if you're short, if you've participated all the short side, you should be aware that you're really pressing at that point. So I took all my shorts off except 2 that I have that are big cap shorts. Big cap tech stocks, because I think the next phase will be these stocks could rally for a while, but the selling in the Apples of the world, the distribution in these names, is probably not done. Probably. Now, if I'm wrong, I'm gonna get hurt. But this just looks like it's just starting to roll over, right? Apple, Tesla. You undercut this low, natural place for it to rally. But, these stocks look like they're just sort of starting to come under distribution. Now, they could go up as well if the market rallies. But one thing I noticed today, the QQQ was up 3.7% and Apple was up to, 3% as well, but less than the overall market, which is a little unusual. Tesla, normally if you're short on a day like today with the NASDAQ up, how much was the NASDAQ up today? 3.3%. if you had told me Tesla or the Nasdaq's gonna be up 3.3%, one, I wouldn't want to be short Tesla, but two, if I'm short it and have been, I would be okay with the fact that it was only up 5 and change, 5.7%. I actually thought, oh, I'm going to get my head torn off being short this one into a day like today with the news that Musk might be walking away from Twitter, doesn't need the shares, etc. So they're a little heavy. There's some resistance on these big cap names, I think. Well, we'll find out. Time will tell if that is how it plays out. But the other names, they might be able to rally for a day or two or weeks because they've just been so beaten up. So back to the slideshow. This is KWeb. This was the kind of the QQQ of China. And it was the first kind of shot across the bow, the canary in the coal mine. You know, when this got hit, everything was going good in our markets, and this is just getting really hit really hard. Let's go to KWeb currently, because I want to do some markups. There's a reason I've gone down this story for a long time. At least I know you guys are hoping there is. Once it broke the 50-day, this is so cool. Once it broke that line, it could never really rally above it. Do you see how it almost got there? Do you see how it got there right there, but couldn't close above it? How about there? Couldn't close above it. Here, 3, 4, 5, 6, maybe 6 of the 8 weeks was above that line. And if you love Chinese tech stocks there, like PDD and JD and BABA, maybe you buy it there, but you would have got stopped out. That's okay. You would have lost very little, but then rolled over. So you see how it can't hold this line, couldn't get above it, can't stay above it, pokes its head above the line, cannot close above that line, cannot close above the line, cannot close above the line. That's what you have now for the market. For if it's ARK or whatever you're looking for, you should be, this is your playbook. If the market can't close above that line, then you're swimming upstream. So I'm really waiting before I get aggressive long side. Besides, obviously, I'd like to have a follow through day. Is I want to see the market close above that line. Now, right there, right, closes above the line. Okay, I'm going to go long there. And, you know, it works for a week, maybe 6 days, and then rolls over, and I'm going to get stopped out. And I'm going to keep trying that for a little bit, because one of these times it's going to work huge, right? Like that, right? Like that, like that. So if you don't have anything, at least have some type of system, you know, where you're using something as very simple as, then use the 10-week line. I think it's just, you know, less noisy. You know, if you look at the daily, there's gonna be a lot more signals. I would use the weekly line and just look for the NASDAQ to close above that line, and before you decide to get aggressive to the long side. If you're a long-term investor, this is kind of your ceiling. This is the 40-week line. It's a great spot too. Very few signals, right? Long, 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 long. I'm out. Buy, buy, buy. I'm back in. I'm back in. I'm back in. I'm out. I'm back in. I'm out. Another great one. You're going to give back more using the 40-week line, but you're going to have less trading, less signals. You'll ride longer waves using the 40-week line. So maybe that's more suited to your style. Not for me. I prefer the 10-week, but you know, I think either way is fine. Either way is fine. And I have a really good friend, amassed, done really, really well from just trading. And, you know, he just says all the bear markets, if you study, they occur below this 40-week line. So when the market's below the 40-week line, he just is disengaged. He just doesn't do that much. He's in protection mode. Because I've been in this game a long time, and a lot of you probably have as well. I think making money is easy, and I don't want to be, you know, what's the right word for that? But I think making it is easy. Keeping it is hard. keeping it is hard. So sometimes you have to be in protection mode. Protect what you have, because when the next cycle comes, you have mental capital and physical capital to ride it up. A couple of other observations about the markets. This pink one, this really light pink one, is the 150-week moving average, which is a great long-term moving average as well. Again, very few signals, but if you're going to buy, like, I have a strategy that I've developed where I feel like I should be putting money into like mutual funds, maybe a little bit of my money into mutual funds and just leave it alone. So I was trying to develop like a timing strategy on when I should buy them, not when I should sell them. I'm not going to sell them, but when I should buy them. And the 150, when I went back and looked, it's a great time to be buying mutual funds. Now, I would have been, a little bit gun shy there for sure, but we're right on that line, right? So we've come down to this support line on that moving average. On the S&P, though, we're a little bit above that support line. So it's a little bit early for the S&P, but you can see how well it worked here and here. And if you go and look at some mutual funds I was considering, like Fidelity Contra, well, what if I bought Fidelity in December 2018 or in March or April of 2020? Fantastic buys. This is the third time. Maybe this is not the charm. It's possible. But if I have low cost mutual fund there, low cost there, and I'm just using a small portion, that could be something to consider. PRNHX, never got there. Look how well it held up. But all of a sudden, this one's performing much, much more poorly than the others. They have changed managers, so it makes me wonder, maybe the strategy is slightly different. Every portfolio manager has their own strengths and weaknesses, but that's another thing to consider as far as the long-term trend of the market. So we're right on support. It looks like a weekly support bar. Let's find out. Let's find out. So if we go to the daily, what's IBD going to be doing, right? Yesterday was day one. Today is day two of an attempted rally. So the S&P yesterday was day one. I know it's pink, but it almost closed unchanged, down 5 whole points on a 3,900. And you have a big bar back. This is what, if you're looking for what they call a pink rally day, that's that. So this is day two. So somewhere along the line, we are going to get, hopefully, maybe, I don't know, day 3, day 4, day 5, day 6, day 7, follow through day. If the market does all this and then takes out that low, then the count will start again and you're back to 0. So we'll see. My instinct is, if for whatever it's worth, I think it's going to be a bear market rally. But I will tell you, and I've said on IV Live, I always think they're bear market rallies at lows. So don't, put too much weight into what I think, because it's like I thought this was a bear market rally, and that this is a bear market rally, and it turned out right, but one of them won't be. So I will put a little money to work each time, just in case, looking for leadership and feedback too from the market. Anything else in the market related that I wanted to talk about? Let's look at the Russell. It's not as good an indicator for this moving average. Look how far down it went below it, how long it lived below that. So that, I think I would 86 that for that, as far as using that as an indicator. The Russell's a strange index. It's never could quite understand where the leadership is in the Russell. All right, so let's go to, I was reading in Barron's about Berkshire from 65 to 21. Berkshire generated a 20% return versus 10.5 for the S&P, just beat the pants off the S&P. In the last 20 years, though, Berkshire is ahead by barely 1%. What does this mean? Well, they did really well early, They probably had a much bigger edge then, an informational edge. That edge is, even though they have much more information than you and I, that edge is closed for sure compared to everyone else. And it also means that the M in CanSlim, the market, is so important. You can't swim upstream. You're subject to the market at least a little bit. I don't care how great a stock picker you are. I don't care how great an asset allocator you are. You got to have a market to work in, and and that's the key here. Is Berkshire needs the market to go up to make the 10%, generating not a ton of alpha, but the alpha, their career alpha is huge when you're 2x the indexes previously. So food for thought. I know I've talked to a couple people. They're having a tough time this year. Some friends that have reached out to me and said, I'm not doing that well. It's you're swimming against stream in the market, and the cycle might be different than what you're used to, right? I've been through cycles like this. And so my strategy of selling on the way up hurt me a little bit in 17, underperformed people I knew in 2017 because I was selling on the way up and they weren't, and everything kept going up, never pulled back. But it protected me immensely last year and especially this year. So you have to know that when you're doing well, it's not all you. You're not the greatest stock picker. You're not the greatest trader in the world. And when you're doing poorly, it's not all you either. It could be a lot that you're just stuck in a cycle that doesn't fit your style of trading. You have to recognize that a little bit as fast as you can. All right, let's go to the industry groups. All right. Energy Coal One, Oil and Gas Royalty Trust, Oil and Gas International. We're going to do this, guys. We've been here before, right? It's all oil and gas, all energy. I haven't done Chem Ag is one of those outliers, but I don't understand the science too good, but I do realize that I guess fertilizer has a natural gas component. So it's pretty much the only area you can be in is energy if you want to navigate on the long side. So like, there's been some stocks, Sting, which is oil and gas transportation or pipeline, they have fleet of oil and gas really well. Like yesterday, I noticed didn't want to go down. Today had a huge day. GLNG, I might have mentioned this before. The dreaded high tide flag. Shakeout week, but closed in the upper half of the week. The closing range is 74%. And so if it can, jump above this area, I like that group. What else? Oh, PXD. It didn't do anything much this week, but nice and quiet, but, hanging in there really close to new highs. EQT, which had kind of a shakeout. I actually bought that off the 50-day this day, and then it just got out the very next day. Market. It's really hard to be long stuff when you're seeing the market just pushing new lows every day, and you just have this crash feeling in your mind. And there's another clue that maybe we're close, because I was like, I just pushed everything out a few days ago, just wiped the slate clean. Energy, ag, it didn't matter what it was. I just wanted out of everything, just because I felt like there was a chance the market was going to crescendo waterfall lower. Other anecdotal evidence, I moved my kids 403, no, the 403B is my wife's IRA or teacher retirement thing, but I moved that to cash this week when I got the statement. I just hadn't been watching. It's, not a ton of money for her, and I just hadn't been paying attention. I got the statement. I pulled it up online, and is down like 8% on her equity portion and 2%. She was down 2.8% on the Treasury. I'm sorry, the inflation protected bond index that I bought. That was really disappointing. Why that was down. I mean, I was expecting that to be up. That's why I bought it. So I just pushed all that to cash. And then my kids, not their Coverdales, which I can own stocks in, but their UGMA. Why am I blanking on this word? But understand the education accounts that own mutual funds that I've been contributing to for years. And my daughter is getting older. She has one more year before college. So I probably should have been thinking about this anyways, reducing the risk. But I just pulled those up and just, went to cash. So there's just two great anecdotal evidence that were probably very close, because I was fearful, like I said, that the market was just going to continue to just waterfall every day. And I got tired of watching those products bleed to death. So food for thought. So their energy is holding up. But today was, I showed you some of them. That was the stocks that have been beaten up so much. They were the ones that really, really jumped today. The GitLabs, the DLOs, the PAG Seguras, and there's some hedge funds that I follow. Their holdings, Altimeter Capital. 5 years ago, the guy's the smartest guy in the world, and I think he was one of the seed investors in Facebook. And he again, going back to my statement, he just when it's going up, it's not all him, and when it's coming down, they're down like 35% this year. It's not all them either. They get too much credit on the way up, and too much blame on the way down. I really think it's part of kind of the process. Same in sports, right? Coaches, players, too much credit when they win, too much blame when they lose. It's not entirely that black and white. But he owns a lot of GitLab and C Limited, and there's another fund I follow. He owns, still has 44% on the last reporting period that they've done in C Limited. Now I'm guessing he's still up because he's owned it for a long, long time. But gosh, still, it's a long way to watch it come down. But the reason I say that is that maybe there's something to the story there, and there's a reason they did this. And maybe this I really believe was an overthrow. Like I talked about the 22, I think this is an overthrow rally, but maybe we're overthrowing the wrong way as well. Look at this weekly bar. I'm going to go back and look some of my model books and study and see, previous bear markets, 70s, 94, 2000-ish. Do you have any of these kind of weird weekly bars? Is there any kind of potential signal there? Because that's just crazy weekly bar right there. Down, closed practically unchanged, 25% off the low. I think DLO has the same kind of weekly bar. Yeah. And this was a company I made money in here. And look, the earnings and sales, I'm guessing they're going to not look that good going forward, but you always want to be thinking ahead, like where could the next potential leadership come from? Now, really, truly, these need a lot of time. The best way to buy something like this is not like this. I don't think. I've never been through something like this. I'm going to study it, but it runs up, builds a base, and I buy it at 36 months from now. GitLab runs up, builds a base, and I buy it at 56 months from now. I think that's probably the best way to do that, but I'm going to go look. And, Globe had that same thing. What was the other? There was one other that had like these really crazy, was PAGs. I don't know if this one's sort of the same thing, although that one looks a little worse than I expect. But you had a lot of these names that these hedge funds really liked have these bars, these really big support bars. So food for thought going forward. Maybe it's a sign of hope for the market 3, 6, 9 months from now. I don't know. But like I said, I'm hopeful. I'm always going to have a watch list looking for areas that I think the leadership is. Right now, I think you're much better off buying stocks closer to new highs. I don't know if you saw my tweet, but I definitely believe that. So, Sting was one that I bought, GLNG. I think they just act better. PXD, like I talked about, they just act better close. It doesn't have to be at 52-week highs, but within stone's throw, 10, 15% of 52-week highs. I think the stocks are just much better to be buying them there. And those names maybe in, like I said, 6, 9 months from now will be closer to that. So if I fast forward to DLO, eventually all of this will fall off of a daily chart or the 52 weeks, right? And it's gonna, you won't be able to see any of this. So maybe this is going to be the left side of a big cup with handle or something like that, right? And even though you have all this resistance up here, it's only relevant within like a 52-week period, which maybe even a little bit less, I think. If you own DLO at 60 or 70 and you haven't sold by now, then you're probably not looking to sell if it gets back to 60 or 70, right? You're not going to have a bunch of overhead, but all the guys and gals that bought here that are trying to catch lows, and you have these people that were trapped in this gap down, that's why it struggles in this high 30 area, right? Because you get these rallies and then you have people that want out and they push it back down, and you get the rallies, and then the people that want out, they push it back down. So it's, who knows, we'll see what happens. Last thought before I go to the thought of the day, the quote of the day. The RS line, Jim Ropel had said something about the RS line new high, which is very important, and I've said before, but I want to repeat it. Is right now the RS line is going to have the Hershey's and the Colgate Palmolives of the world. So it's not as good an indicator when you've been this beat up in the market. It's going to have all the stocks that the institutions have run to for safety. As they get more willing to put on risk, if the market just goes sideways for a little bit and stays here, then these other names will start to show up. It'll take some time, but they'll start to show up. So that list will become all the more relevant. So when you've had a market come off this far, this much, then it's the names in there won't be as relevant to the leadership yet. They won't be yet. Fast forward a few months from now, if the market hasn't made a new low 3, 4, 5 months from now, that's going to be your golden ticket. Those are going to be all the best names. All right. So the quote of the week is from Dan Loeb. He's founder and CEO of Third Point. Since I started it 27 years ago, I've seen many investors stumble after years of success because they didn't adapt their models quickly enough as conditions shifted. They don't ring a bell when the rules of the game are changing, but if you listen closely, you can hear a dog whistle. This seems to be such a time to listen for that high-pitched sound. So it feels like the game has changed. The market's not going to reward companies with no earnings. They're going to have at least some kind of earnings, or if not, maybe just tremendous sales growth. But the market is, the cycle for that type of speculation has ended. It's over. It's not, some of those names, I'm sorry, they're not coming back. The Shopify's and the PayPal's, I hesitate to say, but highly unlikely they see those highs. Can they, pivot and become leaders again? Probably, maybe. I would rather say maybe, but there's going to be new leadership. So you really want to kind of forget about the squares and those names and focus on, the new leadership. Where is that going to come from? Which is why I'm looking at some of those names that are newer companies that these mutual funds, these hedge funds still own for whatever reason. They must know the companies really well. The stocks don't look so good, but maybe they know something about the companies. They'll know those companies much better than I will, that's for sure. All right. The contact information, marketsmith@investors.com, 800-831-2525. I feel like this one went really long. I apologize. There's just so much to talk about. The markets are crazy dynamic. It's, hopefully you're not getting hurt. If you're losing a little, a lot of people are. If you're making a little bit, great. I don't think anyone's going to get rich in an environment like this unless you're a total bear, and that doesn't pay in the long run. So stay nimble and stay active, stay engaged for sure. Feel like people were starting to kind of drop off as far as engagement. Don't give up on that. That's for sure. All right. Thanks a lot, everybody. Have a great weekend. We will talk to you next week. Bye-bye.